Perhaps the most prominent doom and gloomer when it comes to economics and finance of the past decade or two, Peter Schiff, was on the Patrick Bet-David show today, doing what he always does, hyping up gold and talking about how the American economy is about to collapse. But in my view, him doing this and selling this to his audience and other people is actually harmful to the average investor. And keep in mind, this is not financial advice, not intended to be financial advice. This is me giving my take on Peter. Let's get into the clips here.
But every time the Fed creates a misallocation of resources, malinvestment bubble, every time it pops, instead of allowing the market to fully correct for all the mistakes that were made in the past, right? The recession, as far as the business cycle goes, this boom-bust cycle, the boom is where the mistakes are made. The bust is where they get corrected. And you have to allow the market to do its job.
Okay, so this is Peter's largest problem, I think, and he always starts from this, talking about how he thinks the world should work as opposed to the way the world actually works. He's gone on record lots of times railing against Keynesian economics and this idea of these large central banks that intervene in the economy, but that's the way the world is. He always goes on this rant starting from the world shouldn't have all these powerful central banks. It does. They're going to intervene. So every bit of advice past this is just operating in a fantasy of how you think the economy should run.
Job. But in the short run, that's painful because people lose their jobs, they lose money, and the voters don't like that. So there's always political pressure on the government, the Fed, to try to fight a recession when the recession is the cure. So fighting it simply makes the disease worse. But what they do is they keep creating more inflation, and it's kicking the can down the road.
So yes, Peter is right that Republicans and Democrats are probably going to keep kicking the can down the road. So do what everybody else in finance does and in money management and take that and put it into your calculations. It's all based on, when Peter talking about how bad of an idea that is and how that's distorting everything. Everybody else has just accepted that and then baked it into their calculations when they're buying assets. Yet Peter keeps coming on here trying to be the one guy who's going to convince the entire world that we shouldn't do it like that.
And postponing the inevitable, a pain. But every time they do that, they make the underlying problem worse, and therefore the ultimate pain to resolve it, right, worse. And so my point is we are now at the final, crossroads.
Oh, really? We're at the final crossroads. Okay, I'm going to go on Peter Schiff's YouTube page now, and I didn't even look this up before I made this video. This is from 1 year ago. The banking crisis is at the cusp of a much worse financial crisis. And look, his videos, it's always the final crossroads with this guy. He's been saying this for at least 15 years since I've been aware of him. Inflationary depression hitting 2023, that didn't happen. Okay, here, 2 years ago, America, the next Greece, who recently just went through a massive financial issue there. Here now we have 4 years ago, stock market bubble bigger today than 2008. That's 4 years ago. Here, house of cards will tumble down on consumers. Here's one 6 years ago titled The End is Near. And look, you could click on most of these videos and you'll hear him talking about how the collapse is right around the corner. He even does it a few more times in this video. You'll hear him reference things like that.
Where the Fed has to pick the lesser of two evils, right? So on the one hand, it can fight the inflation that it created, with QE and all this, the expansion of its balance sheet. It can fight the inflation. But to do that means interest rates have to go much higher than they already are. They have to go high enough to force massive cuts in spending on the government level and on the household level. But our whole economy is based on spending right now. It's a bubble. And so they have to create a massive recession.
And look, the problem when you keep claiming there's a recession around the corner, you're getting average people scared. They're not going to invest in the stock market. And investing in the stock market throughout America's entire history has been a fantastic way to build retirement, save up for a home, save up for your children's college fund, things like that. And we'll get to some numbers here comparing the price of gold to the price of the stock market once Peter is done here explaining his position.
it's not that recessions are necessary to fight inflation. It's just that what's necessary to fight inflation will also cause a recession because of the underlying nature of the economy. And this recession, which will have a housing market crash, a stock market crash, will result in a wave of defaults and failures. There can't be any bailouts like we did in 08. So when a bank fails, they can't bail it out. They have to let it fail. And they have to allow the depositors to lose money. There's no money to bail out the depositors. They have to lose.
And another thing Peter fails to mention, even though he probably knows it's true, America is not the only country in the world with this ridiculous spending problem, which they have. It's also China. It's also pretty much every Western country. If you look at debt to GDP ratios across the world, they're out of control. The entire world has this problem. America is still the strongest economy on earth. It has Silicon Valley. It has a great position globally in terms of being protected by these massive oceans. America is still in a kind of a sea of a world that has this ridiculous spending problem. America is still in the strongest position of them all. I mean, that's potentially arguable, but in terms of the strongest economy, strongest military, it's America. So when he talks about all this stuff, like America has the most leverage of any country on earth.
The government has to tell people on Social Security and Medicare, we just don't have the money to make the payments. We're not talking about making cuts for people in the future. The checks we're sending out right now, we don't have enough money. We gotta make those smaller. Right? Social Security, the trust funds, so-called trust funds, are already selling treasuries right now. Social Security already takes in less than it puts out. It's insolvent. So the government has to tell government pensioners, we can't make the pensions because we're broke.
But he speaks about the pension problem, that the government's just not going to pay pensioners, like it's a 100% certainty of happening. Obviously the U.S. government and other governments around the world have a capacity to take on a whole bunch of debt and still function. It's not ideal. It's certainly not the way it'd be drawn up in like an Austrian economic system, but it's happening and it's continuing to happen. So how can you be so certain that just because you think it's not right, that you can just say, boom, it's going to get cut off on this one date that I'm going to say. And again, he says it's every day. He says, okay, in 2019 is the problem. In 2022, tomorrow, in 2025. How do you know when this is just all going to actually stop? And the answer is you don't know. You just keep pretending that you do on all these podcasts.
We actually have about a $3 trillion a year deficit right now, maybe closer to 4. I mean, even if they massively increase taxes on the middle class, I don't think there's enough they could do it. So they have to make these deep cuts to government spending. And of course, that's going to be very problematic for people who were counting on Social Security or who lost their savings in the bank. In fact, if the Fed really fights inflation, we probably can't pay the interest on the national debt because right now we're spending about $1 trillion a year on interest on the national debt. If the Fed, let's say, raised interest rates to where they need to be, given the short-term nature of the debt, within a few years, we could be spending $3 or $4 trillion on interest on the debt, which can consume 100% of tax revenue.
Now, the thing, when he brings up all these points about the government of USA, specifically the US government, their problem with spending, he's right. And they do have a massive problem. And that's probably why Peter's been able to have this relatively successful media career and keep popping up on all these podcasts, because he is good at spitting out the facts of the problems that the U.S. government has with spending. But the solution to that is not just to buy gold and to think that the collapse is coming right around the corner. Again, if you do think that, and we'll get to that in a sec, you've had way less investment return over the last 10, 20 years. If you're constantly living in that fear zone, thinking today's the day that everything's just going to collapse.
And of course, we can't cut Social Security, cut Medicare, right, and pay the Chinese 100 cents on the dollar. I mean, that's just not going to fly. So we would have to default. We would have to tell our creditors, we can't pay you what we owe you. Well, maybe we'll pay you, some discounted rate. So all these difficult things are going to happen if the Fed really does what it needs to do.
And this argument, which I've heard him bring up before, that China holds a lot of U.S. debt, and we're going to have to tell China that you're going to have to take a haircut on this debt. I think that had a lot stronger argument. It could be used to his favor a lot more a few years ago when it looked like China had this rapidly growing economy that was about to take over the United States. That still may happen, but China's had a lot of problems in recent years, and that just, again, highlights my point I said about earlier. U.S. has a spending problem. but so does essentially every country on earth. It's a global problem of just this kicking down the road phenomenon, because politicians it's just so much easier for them to do that. It's every country. This is not a uniquely American problem. China has its own problem. China has a ton of debt as well.
But politically, that's like a non-starter to force all those, tough choices on the politicians. So the other choice they have is, okay, we're just going to allow inflation to keep continuing.
Look, inflation is a real problem, and it's certainly caused in part because of the central banks' constant bailing out of the economy and constant printing of trillions of dollars. But Peter would say gold is a great option for you to hedge against inflation. But Patrick Bet David here makes a good question about, is it really?
Let me ask you this: this question goes to everybody, but how different, specifically you, Peter? How different is, typically it's like, well, if we print $6 trillion of money, the price of gold is going to go to the roof. We're like, oh, that makes sense. Rob, can you pull up the history of price of gold? What do you call it? The link I just sent you, right? When you pull this up, you'll notice, okay, gold prices are super high right now. Okay, where are they at? 2,300. It's still less than what it was in 1981.
Well, that's inflation adjusted.
But what I'm saying is, so
not just
I get that, but
yeah.
So is gold really a good inflation hedge, or is it even just a good hedge against if you think something bad is going to happen in the economy, like Peter, you think a crash is going to come the next 2 seconds? Here, look at this is 100% or 100-year return of the some stock market or some indexes compared to gold and silver. This 100-year return, gold plus 11,000%, so not bad over 100 years. S&P 500, 61,000%, so way better, 6 times better. And the other thing, this chart here is not even including dividends. This particular chart I'm looking at in the moment, like on the screen. Gold just sits there if you buy it as an investment. It sits there and is just shiny. Doesn't do anything. Warren Buffett's talked about this, but it's just an obvious truth. It just looks cool. It sits there. I mean, yes, it maybe has some industrial uses, but in terms of an asset, it doesn't make you money. If you buy stocks, they return you dividend. They're real companies. So those can be reinvested right back in the stock market. So the return is actually way, way more than this. And there are charts that show this, but I'm just proving this here to prove this point, that not only does the stock market return over historical averages way better than gold does, it also returns a dividend. It also pays you money. So even if you don't pull the money out and you just sit there, or you don't pull the actual initial capital out and you just sit back on it, you get more return on your initial investment, and you get dividends put into your bank account if you want, or else you can reinvest them as well.
$600 was in 1981 versus today, it is what it is, right? 2,400, 2,300. Okay. So, well, if we keep printing, shouldn't the non-duplicatable assets continue to grow? In my mind, gold, with all the amount of money we printed, should be at $6,000, should be at $5,000.
Well, it will be.
Now, did you catch that? This is such an easy position for Peter to argue. It will be. Look at all these historical facts and these problems I pointed out with the U.S. government. Again, he's correct on a lot of this stuff. He just hyper-focuses in on just the U.S.'s problems, and he doesn't accept the fact that this is the system we have. We created these massive central banks in part to kind of promote world peace back after World War II, or whatever the multitude of reasons was. This is the way the world is. We have this banking system that gets bailed out when things are going down in terms of value. And I have a lot of problems with it too. It creates this massive wealth gap, but it is the way that it is. And you can't just say, it will be. Trust me, gold's going to go up. It will be. Just, it's not up right now, but it will be.
Well, it will be. Now, when you go back and look at that chart, obviously in 1980, gold got overextended, right? As markets often do, right? Gold went from $35 up to $850 or so. And then it pulled back down, but it never went anywhere near the $35 where it started. And it did bottom out in 2000, 200 and change. That's when the Bank of England sold most of their gold, like right on that low, right? They got rid of a lot of their gold. But since then the gold went on a run from under 400 up to 1900 in 2011. So it had a big move. And now, it's just been going sideways for about 10 years.
So why aren't any of these things triggering it?
No,
though?
it's triggering it now. You see, I think we're at the beginning of another sharp line up, just like that one. That's going to take the price of gold probably $10,000 to $20,000 an ounce.
I mean, imagine going on shows and arguing from this position of some hypothetical thing you think is going to happen. He's been doing this ever since I've watched him. He argues for this dystopian thing he thinks is going to happen just right around the corner. It's about to go to $10,000, $20,000 an ounce, and then I'll argue from that position about why gold is so great. How about Peter, like the rest of us, you live in reality, you understand we have the central bank all around the world, not just the United States, these central banks that are so powerful, they're going to distort things, they're going to print way too much money. It's just the way that it is. You can't keep arguing that actually gold is the best hedge for all this, because looking at history, a far better hedge against this chaos has just been to buy American companies, buy strong American companies like the ones in the S&P 500. And yes, inflation will erode away some of those returns, but you'll get rewarded more than just by buying gold and just hoping that you happen to be right and catch that pump up to $10,000, which I think would bring the total market cap of gold to some ridiculous number like 40 trillion. And as I mentioned before, it's also just common sense. You're buying a real asset that's going to give you a dividend, a real company that earns money and that returns some of that money in the form of dividends to shareholders. You buy gold, you're just buying something because it's shiny and has been around for a long time.
So you're going to see it. It's just that, it's not linear. It went sideways for a while. A lot of the inflation went into the financial markets. Why do you think the stock market went up so much in America? Inflation did that. It wasn't the real productivity of U.S. companies. It was inflation moving into the financial markets.
But it was both, Peter. It was the productivity of these companies, which they are still productive. U.S. GDP still is growing. It's not growing at 3-4% consistently like it was in years prior, but it's still growing. And yes, it was also the rise in these prices was funded by all that printing of money, but essentially every other money manager on earth has just accepted that as a reality. Not everyone else is trying to come out here and prove to everyone why you're correct and the entire world is wrong and why people should just buy gold and give double middle fingers to the American economy.
Went into the stock market, went into the bond market, went into the real estate market. Now it's moving into the real economy and it's moving into gold. And so you're going to see a much bigger move in the price of gold.
So here are my final thoughts here on Peter Schiff in this video is I've been listening to this guy now for years come on TV and pitch this idea that the American economy sucks and you should buy gold. And at first I was intrigued. He makes lots of good points about the problems of the American economy in terms of anytime there's a problem, they just crank interest rates to zero and print money and kind of pretend that things are all fine. But the problem with Peter's advice is if you're just an average investor, you're going to potentially get scared if you listen to him, pull your money out, and then you miss this massive stock market run, which we've still been on. I've heard him start talking around 2015. There's been a huge run in the stock market since then, at least over double, and then more than that even with dividends. And if you just get so scared that you're constantly dipping in and out or not invested at all, you're missing a huge opportunity. And if you listen to guys like Peter Schiff and just live in fear all the time, yes, you're going to be right maybe once or twice in your lifetime, and there may be this big economic crash like there was in 2008. But then if that happens, is that really going to be correlated to gold for one? Is gold going to go way up as the economy goes down? Because as we've seen, when there are massive financial crises, correlation goes to one. Everything just drops at the same time. So things don't always work as you're theorizing them in your head. And so I think the major problem with a guy like Peter Schiff, who comes on these podcasts, makes good points, but then scares everybody and tells them to buy gold and says the American economy is about to collapse, is that then the average investor may believe him, not invest, and they don't get to enjoy the returns for American business, which historically and likely in the future, I mean, we never know. Maybe Peter will be right and things will collapse, but at least looking at history, if you just buy a simple index fund and forget it, you do way better than you do if you're constantly living in fear, thinking that things are going to take a major turn for the worse economically and stocks are going to crash by over 50% overnight. Thank you for watching. Have a good day.